Hey guys, welcome back to this. We're talking about developing patience and knowing when to trade, part 2. Let's get straight into it. Right, so why do we wait? We talked in the previous video about waiting for your edge and whatever your edge may be, and I kind of gave an example of a couple of things that might be your edge. So next is the question is, why do I wait for these conditions? And then this is the kind of question you'd ask yourself for, why am I using this edge? And so we're answering this question, why am I waiting for these conditions? Where's institutional order flow, all there's retail trading from an emotional perspective? It is simply because I believe that people are more predictable under certain conditions. The crowd is more predictable under certain conditions. Don't forget this whole concept of trading. We're trading people's expected reaction to price. When we go long, we are hoping that other investors, other market participants will buy after us. So we're hoping that as the price ticks up, they will continue to buy. I won't go in super depth with that. By the way, if you're interested in this kind of, there's good stuff coming up, guys. Make sure you are subscribed, because we'll go into some of this depth later on. But that is the point, right? We're not trading a number, we're trading the crowd behavior or expected crowd behavior. Where do we expect the most money to go? Into the stock, out of the stock, not doing anything, another stock? That's what we're trying to do. So, because if no one else buys, guys, the market is not going to go up. There's no point you saying, yeah, it's the greatest thing ever. But unless other people believe that after you, the trade's useless. You could be sitting there with the best investment ever, but it's never going to go up in value unless someone else believes it, and someone else and someone else and someone else, or someone else with more money pushing that market higher. So it's remembering this, that we're trading people's expected reaction to price. Okay, I think that people are more predictable under certain conditions, i.e. under stress, i.e. under institutional order flow. So that for you would be answering the question of, why do I wait for my edge? And if you say, well, it's been statistically proven that this pattern works well in this market, great. Or I've proven that over time my trades work best under these conditions, great. Whatever it is you're justifying, because this all helps the mind, guys. It's all about the mind saying, okay, I understand why I'm doing it. I understand why I'm waiting for my edge. I understand why I need to be patient, because it's in my best interest to be patient. This is why it's in my best interest to be patient, because I believe this is where my edge lies. Now, if you're right, are you wrong? This is a completely separate topic, but the point is, again, we're trying to reinforce this belief and behavior. It's a very important question to ask of, what reason do traders have to buy after me? What reasons do traders have to sell after I've sold short? If you can't answer that, then there's probably no trade, because that's a lot easily forgotten thing, guys. People forget and say, well, it doesn't matter, I just think it's going up. No, there's got to be a reason. What reason is it? Is it because of institutional order flow? Is it because you think people are still panicking? Is it because you think people think they're missing the boat? What is it? Is it because it's a broken out and this and this and this? What is the reason why, after you've bought that stock, after you bought that futures contract, that spread bet, that whatever it may be, that someone else is going to think, hey, it's a really good buy, and buy it at a higher price than you? Because if there isn't a reason, you just think it's going up, you may not have a trade. Now, this might work for you specifically, but it works quite nicely for me. This is why we look at conditions which encourage our trade direction. I'd say let's not go down too much of a depth here. I've got some stuff, good juicy stuff coming up in relation to this, but this is why we do ultimately look at the conditions of the market, and why I'm very much an advocate of saying, what's the price position relative to the setup, etc., taking everything into account before making a judgment, because that's so crucial. Just very briefly, a breakout in a 6-month range on a 4-week breakout is a completely different animal to a breakout that's at a 52-week high when you got 50% of the float short. Same breakout, exactly the same pattern, completely different scenario. Then you can kind of extrapolate and work out what people potentially could do, the behavior of the crowd, how they're perceiving it, etc., etc. Which is why, going back to the first kind of video talking about money flow coming in from institutions, looking at the way institutions are flowing, you think the institutions have got a lot of money to put to work because they want to tuck it away in their portfolio for a long period of time. They don't care so much about short-term movement in price. They care more about the long-term value of that asset. And so we can capitalize on that by saying, okay, you don't care about short-term price, we do. We care about the next 1, 2, 3, 4 days, 4 hours, whatever it may be. So we're going to ride on those coattails and push it higher. So again, it's kind of structuring things a little bit differently, a little bit of a alternative view on the market, but that may well hold you in good stead. All right, guys, see you in the next one. Part 3 coming up.